Welcome to the focusIR Fireside Chats with me, Karl West. I will be bringing you interviews with fund managers, economists and analysts. Plus, we'll be sitting down with the founders, directors, CEOs and company chairs that make things happen in the boardroom. I hope you enjoy the show. Welcome Judith MacKenzie to focusIR Fireside Chats. Judith is partner and head of Downing Fund Managers, the boutique investment arm of Downing LLP that she founded in 2010. Downing has a focus on small and mid-cap companies listed on AIM and is a B Corp certified responsible investor with a commitment to meeting high standards of social and environmental performance. Judith, welcome to the show.
Good to see you, Karl.
As I said in my intro there, you invest mainly in small cap companies. Just talk us through what you look for when you're considering new additions to the investment portfolio.
Although our team look at small and mid-cap companies, I predominantly, well actually all I do is look at AIM companies, so that's the junior market of the London Stock Exchange, and there are about 600 odd companies on AIM, and we select a portfolio between 25 and 40 stocks for our investors. So what we're looking for when we first invest or first looking and screening for a company, we're looking at cash earnings. That's really important because I've been caught out quite a few times by just looking at accounting earnings and not really understanding where the cash is. So we're looking at the quality of the cash earnings, and what we like is a company that is quite niche, and that means it tends to have quite defensible margins, and that might be through regulation, it might be through legislation, or it might be because they've got a really strong brand. So really just trying to identify companies that do have that bit of an edge. And then we're looking for companies that we feel have been a little bit overlooked. And the great thing about AIM is that it's a bit of a hodgepodge of a market. You wouldn't invest in the index itself, but you can find some really interesting companies that might have been overlooked. They might have had a profit warning maybe about 12 months ago. They might have fallen out of favour with the market. But actually, sometimes those are the times that you really do want to get involved with a business, because it can be at quite a catalyst point where you can see that earnings and cash earnings are going to drive returns. And then, so we've managed to find those three things, which can take us up to 6 to 12 months, sometimes longer actually. We feel that we are probably spending more time looking at fewer companies than maybe most of our peers, so we're not getting diverted away by looking at other markets or other companies and larger sectors, where we tend to be looking at this AIM market that is our universe. So we'll then look at the portfolio, and what we do is we tend to create three buckets. One is self-help, so really where that catalyst is going to play through. Another is balance sheet leaders, so good old boring companies that can churn out earnings hopefully and have a strong balance sheet. And also secular growth. So those are the three buckets that we put our companies into, and that tends to mean that you've got quite a balanced portfolio. So that is a very short way of trying to describe quite a long process. As I say, I think we probably spend quite a bit more time than some others investing in this bucket of companies.
Yeah. Is it easier or more difficult, the fact that you are looking at a smaller and smaller coterie of companies listed on AIM, because quite a few of them have gone, and obviously AIM has struggled over the last few years. Does that make it easier for you, or is that more difficult?
That's a killer question. So it's not more difficult really when we're finding companies. We're not feeling that we are missing out on opportunities that are on the full list or whatever. Not yet. But I do share your concern that the ecosystem, AIM itself, is not healthy. So we've had dearth of IPOs coming through, and we've had too many companies leaving the market, and no doubt I'll come on and talk about maybe one of those companies later on. But so it's not a healthy ecosystem. I would like to, and it's quite a lot of the lobbying that I do through the Quoted Companies Alliance is really all to do with trying to create that slightly better atmosphere for the small cap market.
Yeah, sure. I know that having spoken to you previously, you like to be quite hands-on and get to know management as well. How often do you meet with management, and what do you want to know from them when you meet them?
Um, I mean, there's no kind of tick box in terms of how many times we need to meet before we make an investment. And I think my view probably changed a little bit over COVID as well, when it became more remote. Before I was always adamant that before we made any investment, we would be out kicking the tires of the company on their own sites, etc. And actually through COVID, I probably learnt a bit because we're spending quite a bit more time pre the first meeting doing our work and our prep. And actually, I think that's really quite valuable. So yes, we speak to management a lot. Yeah, we go out on site and meet them in their own backyards and kick the tires. But actually, a lot of what we're doing is that pre-prep work where you're trying to get the killer question to see how they react as much as anything else. So a lot of engagement with management, but now at probably a slightly later stage.
Right. So it's more phone calls or Zoom calls or whatever these days rather than face to face?
No, not really. Maybe initial, but yeah, face to face. We do always go out on site, but it's not the first meeting that we do. It's probably one of the later ones. And really what we're trying to do is cut the emotion as much as you can do out of the investment and look at the hard facts on what they've written, because that's what they should be accountable to. So a lot of work goes into that early period, whereas before we might just go running out to see a management team on site and then do the hard graft after. It tends to be the other way around now.
Yeah. How much does reputation and track record come into it when you're thinking about management?
Yeah, quite a lot. It gives you quite a lot of confidence. We don't tend to invest in IPOs. Not that there's many around at the moment anyway, but we don't tend to invest in IPOs because they don't have that track record on the market. Because actually, the way of acting and behaving as a stock market listed company is completely different to being private, in the way that a management team manage expectation, manage shareholders. So yeah, there's quite a big difference. So we're looking for as long a period as possible to be able to go back through reporting accounts and see exactly what that management team have said that they were going to do, and actually have they done it or not. So therefore, having a chief exec in a FD that's well proven just gives you that extra layer of comfort.
Yeah, for sure. Since the last time we spoke, which was sort of early 2024, the outlook for small caps has improved. I mean, we touched on the difficulties that AIM has had over the last few years, and fund managers in small cap space and now seem to be feeling far more bullish. What's changed, do you think, in those last few years?
I suspect that fund managers are talking about being bullish in terms of valuations on companies, but just going back to that point that you made at the start on AIM, I'm actually pretty depressed about the state of the UK market in general. There were 65 takeouts in 2025 M&A activity, companies taken off the market. We're already beating that in numbers to May this year. We've just had a company bid for in our portfolio. I'm not happy about that. So I think there is something structurally, fundamentally that needs to change. We need more buyers in this market than we have sellers at the moment. And I think the last time there was net inflows into UK equities was in November 2024. So we're really having to work hard to find new buyers for our companies, and it's quite a lonely place to be sometimes. You're seeing share prices that are affected by not the fundamentals of what they're doing, but their shareholders. So where some shareholders are having to sell out of companies because they've got their own liquidity pressures, and I think that to me is quite depressing. So though I'm really positive about the companies in our portfolio and the way that they're performing fundamentally, I'm actually not that comfortable and optimistic yet about the overall small cap market, because we're just seeing too many companies leaving, not enough companies coming in to fill the hopper on the IPO market, and really quite depressed valuations. So we need to see a catalyst to change that. I think that's where what would make me feel happier would be to see that the Mansion House Accord, where basically pension funds are being urged to invest in UK companies, AIM being part of that mandate. If that happened, if we did see a little bit of ISA reform, but I'm a bit depressed about that as well at the moment, then we just need to see a little bit more optimism when it comes to inflows. Once we get that, I think the market itself will kick back really quickly. So I'm optimistic in that regard, but we need to see these initiatives coming through first.
Which is the company that's in your portfolio that's being bid for at the moment, if you don't mind me asking?
No, I don't mind you asking, and it's also one of the ones that is one of our best performers over, 9 years. So first bought this company, Ramsden's. So Ramsden's are in financial services. They do a little bit of pawnbroking. They sell FX to you and me going off on holiday. And they're also one of the largest online and in-store jewellery retailers in the UK now. So kind of multifaceted business. And we actually use this as our a proxy to get consumer exposure. So, but it's not typical consumer exposure. That's a business that we've held since, I can tell you the date actually, 17th of July 2017. And since then it's generated, if you take the bid price as it is today, 19.2% compound returns for us. So, what you want when a company is performing well for you is that compounding effect, and that's exactly what it's done. It's done it in its own earnings as well. But I'm a bit depressed about this one as well. Although the price looks nice, it's at 609 pence and a 34% premium to the price the day before the offer was made last week. I believe that it's valuing it at a kind of derisory valuation. The buyer of this company is called First Cash. They also bought another company that we used to own in this space called H&T, Harvey and Thompson. So they are going to plug Ramsden's into their UK operations at Harvey and Thompson, and they're going to get some fantastic synergies coming through that they're going to benefit from. And I just don't feel that current shareholders are being paid sufficiently to let this viable trophy asset go off the UK market. So, it's a story of one of our best performers that we bought in at £1.34 that, yeah, it's great, it might be taken out at 609 pence, but it's not, I would still prefer to be holding it over the next 9 years.
Yeah. So is it your feeling then that, AIM is a market for growth companies, but your feeling is that it's still a bit of a kind of bargain basement shop for bigger companies to come out and take companies before they've reached their full potential? Is that kind of how you're feeling about this?
It kind of feels like it at the moment, and I don't think it should be like that. It should be a market for companies to grow on over decades. And we've had some great success stories that companies who have gone to the full list. We invested in Ashted Technologies when it was an absolute minnow in the AIM market, and it's now on the main list. There's ASOS, there's various others that could get taken out, but fortunately haven't got taken out. So I don't really want to have the for sale sign up on AIM at the moment, and it just feels as though it is.
Yeah. You touched on a little bit there, your work for the QCA and, changes to the ISA rules. You've been a big advocate for more investment being directed into UK companies. What's your current sense of where we're at in that whole debate?
Too slow, too little, too late, and not quite happening yet. I think all the sentiment is there, and we've been lucky enough to engage with local authority pension funds, the LGPSs in the UK, and actually they're a step ahead from even some of those in Mansion House. They want to invest in UK companies. They are investing in UK companies. They are allocating. They've had their own issues because they've all been, not all, but most of them have been amalgamating, becoming bigger, and they've been going through that process, which has caused them a little bit of pain. But they're coming out the other end, and I'm really quite optimistic about how how much of an understanding that they have about investing in UK companies. And this isn't just about Mansion House Accord and some of those mandates, but this is about them looking at, once they get to see the types of companies in our portfolios, they actually see that the growth potential is there. They see that they can get 20% earnings growth out of an AIM company. And they're not just looking at AIM for the sake of it, they're looking at AIM and small cap in general. So I see the chinks of light, but they're just not happening soon enough. And I think if we could get Mansion House Accord actually moving and allocating to managers, not just ourselves, but right across the board, then that will be the catalyst that we need to reawaken the market. But I keep saying this, I thought we were there round about, the start of the year. And then, of course, the war kicked off, and that just seems to put another a delaying tactic into allocators' minds. And then, of course, we've got the current geopolitical situation, or even the political situation closer to home, that seems to mean that the summer is just going to be a bit dead as well. Yeah. But these individuals want to allocate, and they will allocate. It's just a case of when.
Sure. What's your ideal Downing investment, and what's been your best performing investment? We've talked a little bit there about Ramsden's, but what's been your best performer?
Oh gosh, I suspected you were going to ask me this question, and I meant to go back and actually look at our stats. But one of the better performers has been a company called Volex, and we were first buying Volex when it was about 45p. And it'll be moving to the main market, and it's been 10 times that over the period. We in terms of time of investment, we probably invested about 7 or 8 years ago, and we've been buying it all the way through. And here, what we saw, and maybe just going back to the fundamentals of what we try and do, we saw a business that was in a bit of a state of flux. So Volex is a cable and cord manufacturer. For back in the day, they were the cable cord power cords for iPhones, for example, and that was a £17 million contract, but they were losing about £5 million on it. So, but it was a new management team that had come in, and they saw the benefit in the cable assembly business, especially in Poland, that was servicing the EV markets and creating cables for MRI and healthcare, big scanners. And they were basically professionalising the business, and they at that point said that they could raise the margins from 2 or 3% to 5%, and then they said that they could probably get it with efficiencies from 5% to 10%. And at the point, the cash earnings were only just beginning to come through, and there was a little bit of debt there as well. So you really had to get to understand the business and what the management team were going to do to transform that margin. And in fairness to them, they did it. And yes, probably took about 3 or 4 years initially, but they are now the predominant supplier to Tesla, to the EV market, and they've also benefited from having worldwide outlets, not just in Europe or the UK. They are pretty much in every continent, so they've been a really great investment when it comes to diversifying.
Yeah. How satisfying is it when you, when you strike, when you get a win like that, and how much work goes into trying to spot an investment like that?
Well, I'm smiling. I actually had to stop myself smiling there just thinking about it. So yes, there's a lot of satisfaction. Yeah, look, trust me, I get quite a few wrong as well. We get ones wrong too, so it's not all glory. But how much work goes in? A lot, a lot. And over the years, I mean, what we tend to do now is to take a small initial stake, maybe in the portfolio 1.5% to 2%. And then as we get to know the company better and grow with confidence, then that position might go up to 5 or 6%. And that once you're there, you should know that company better than anybody else in the market. And that sounds really arrogant to say that, but you've got to remember that it might only be about 1.5, 2 analysts that cover these companies, and so the ability to get an informational disadvantage, to take the informational disadvantage is great. It's not, and I don't think AI is going to change that at all. In fact, I think the use of AI in fund management will just push most people to a kind of homogeneous product offering, whereas I think getting your hands dirty, knowing management, doing your diligence, spending time doing it, maybe, as I say, 6 to 12 months actually doing the hard graft, is going to give you an insight that is far, far better than anybody else in the market. And that really is what we do. Nothing too smart about it. That is what we do.
Yeah, absolutely. We mentioned politics just a little bit there. What's your outlook for the rest of the year, and how much does both domestic and global politics play into that kind of stuff?
I don't think there's ever been a time where our financial decisions, our investment decisions have converged so much with politics, and that's both on this side of the water and the other side. So before, I would always give the line, we don't care about the macro, we care about the companies that we're investing in. Now you just can't afford to ignore the short term, sadly, politics that might affect a company. Maybe I'm too much of an optimist, but I would like to get the summer over with. I'd like to know who's going to be Chancellor. I'd like to know what the policies are going to be, and then I can gauge better as to how those policies might affect our underlying businesses. I think uncertainty is just horrible, and that's what we've got at the moment. And that, trying to look through that, fundamentally, our companies have managed to get through the rise in national insurance, the additional costs that have come through via that. But I am slightly concerned about where interest rates might go, inflation might go, and at this point in time, I think we're probably okay on interest rates, which makes equities more attractive. But with inflation that could kick in through the third quarter and the tail end of the year, it could end up being that interest rates go the opposite direction to where we want them to. So it's so difficult to tell at the moment.
Judith, how did you first get into fund management, and how has that changed, particularly for women since then?
It was a long time ago. So actually, I had taken a year out from university, and I was working with a corporate finance firm. And I actually ended up working on the last bit of the BT privatisation. So that dates me right away. I think that was in 1991. And it was actually through that process and through that year that I realised that, one, I wanted to work with smaller companies, and two, I was going to have to try and find my way into the market. I graduated not with the best degree in the world, if I'm going to be honest, economics and finance, and I wrote to every single stockbroker at the time in Glasgow and tried to persuade them to take me on, and I did. I got taken on as an analyst. I only really worked as an analyst for about a year or so. And then I went back to the firm that I'd been on placement with, and actually I was working on as a research analyst in the tech and media space in the tech boom, and we ended up doing an IPO for Aberdeen Asset for one of their private equity holdings. So I was the analyst on that company. It was called Indigo Vision, and it came to market and it did relatively well, and Aberdeen thought I knew what I was talking about. Little did they know that the tech boom was just in the middle of coming off the boil, but they asked me to join them as a fund manager or analyst fund manager, and that really was the route in. But I think when, even at quite an early stage, when I was about 19 or so, before that, I knew that I wanted to work in finance. So yeah, it was an interesting journey at the start, but it's been very rewarding, and in all senses of the word. And how has it changed for women? Massively. There were definitely barriers back in the day that are not there anymore. And if I look at our exco, our main board, there are 7 of us, and 4 of them are women, and you just wouldn't have got that 20 odd years ago, 30 odd years ago. So it's been nice to be part of that journey. I still think there's a long way to go, especially in certain sectors that I see that we invest in companies that are in certain sectors, but certainly in finance I think it's a lot easier, a lot more accepting.
Okay. Just before I let you go, who was your big mentor when you were coming through the ranks, and how important was that for you?
This is a good question, but I sometimes struggle to answer it. I think in terms of one person, I think what I would say though is that I've been lucky enough to work with some really, really good bosses. I've also got a slight intolerance to people that probably aren't good bosses as well. So it's maybe been a little bit out of design, but I've learnt a lot, formatively through every boss that I've had. And that continues today with our chairman, Nick Lewis, and Tony McGing, our chief exec. I think if you're open-minded and willing to be open-minded with good people that you see in front of you, then you get so much out of it. But I also work with people like Martin Gilbert, who you'll probably know from the original Aberdeen days, and you'll know him well. I know from the past, and I was lucky enough to be sitting as a fund manager on a board where he was one of the directors. So I got to see him in action at quite a close level. And when I was at Aberdeen, there was maybe about 250, 300 people, so completely different to the beast that it then became. But I was there through that journey of it growing, and the split cap debacle as well. So I would definitely put Martin down as one of those.
Sure. I mean, he's a formidable character, and also quite a fun-loving sort of a guy. Just thinking back to the mentor role, is that now a role that you're happy to embrace with younger people entering the business now, and how do you approach that?
So yes is the answer. I think certainly I try and be as engaged as I can be, and people want me to be with our younger folk coming through the ranks, and very keen that people get opportunities that might not normally present themselves to them. So if there are people that are keen to show an interest in fund management and ask questions, then I'll go out of my way, mainly because I don't think I would have got a job in fund management now. So if there are people that are showing that keenness and willingness that maybe don't have all the ticks in the boxes when it comes to qualifications, definitely go out of my way. But one of the other things that we're really keen to do, and I've been trying to spearhead the initiative, is to educate in schools. So starting off at grassroots level, because I think the lack of education and knowledge of finance and money even in schools at even a low level or a young age is terrifying. So we're part of an organisation called JFF, Just Finance Foundation, and that's a foundation that goes into schools at primary school level and starts to educate on money and finance. So I'm quite hands-on in that, and looking forward to going into some schools this year to try and teach some 7 to 8 year olds how to think about finance. So yeah, it's something I feel quite passionate about. It's also, I think, a responsibility. If the industry's given me such a great career, then I want to be able to try and make sure that those who maybe don't have the access to financial knowledge get that kind of education as well.
Yeah. Well, fantastic stuff. Judith MacKenzie of Downing, thanks for joining me on focusIR Fireside Chats. Thanks for listening. Don't forget to hit that like, share and subscribe button on Spotify, YouTube or wherever you get your podcasts.